Stocks on Wall Street advancing for a fourth straight day as of Thursday afternoon, with the S&P 500 up a little less than 1/3%. Well, our next guest is bullish on the prospects for Disney, even though the company's been hit by the coronavirus outbreak in China. For more on that and the outlook for the markets, let's go out to Santa Monica, California via Skype, where we're joined by Brett Sifling of Gerber Kawasaki. He's an investment advisor there. Well, Brett, before we get to Disney, let's talk about the coronavirus. The markets, they've certainly more than made up for the steep losses suffered on Friday. Is the market sort of too giddy? Is this an overreaction, or is this move justified even though the coronavirus continues to spread?
Yeah, we've had a largely uninterrupted rally over the last couple of months until last week when we had this coronavirus news. And I do think that it's a little bit more severe than people think. I think China is covering it up a little bit, although only less than 1% of the cases are actually outside of China. It's something that we're actually watching very, very closely.
So what do you think about the market's reaction to it?
I think that the market rebounding this quickly is a little unjustified. I think that's because China is pumping liquidity into the markets rather than we have an actual cure. There's a lot of companies out there that could be affected by this. Most movie theaters in China are closed, businesses are closed. This can really affect things for the quarter.
All right, you mentioned movie theaters closed. Disney's in the movie business. The stock's been hit hard because it also runs those theme parks in China that have been shut down for now. Why are you bullish on Disney's prospects? The stock's still down about 7% from its peak. Do you pick up, or I assume you're saying pick up at these levels?
Yeah, I really love Disney at these levels, despite the coronavirus concerns. Yes, the Shanghai and Hong Kong parks are both closed right now, but if it wasn't for that, Disney would be firing on all cylinders. They've got great growth with Disney Plus, which is really going to be the driver of their story over the next 5 years. They're hoping to get to 60 to 90 million subs. They're already at 28.6, and I honestly think that guidance is low, and Bob Iger and the rest of the team is going to come out and raise that over maybe the next few quarters.
All right, so buy in these levels?
Yeah, we are a buyer at these levels. It's actually one of my more favorable picks of 2019.
Okay. Is China overall a play? I mean, I was looking at the iShares MSCI China ETF, and those shares are down about 6% from its peak after being down as much as 12%.
Yeah, we're staying away from China right now. We have a few individual names. Our entire firm is naturally underweight the foreign markets as it is. We believe that the U.S. is the best game in town, and it has been for quite a while now. So it's something that we're taking a step back for now.
Lastly, cannabis stocks, one of the biggest losers last year. You like the shares of Kronos Group, rather, even though they were down 64% over the last 12 months.
Yeah, Kronos has been down along with the entire sector. And, let me preface this with, individual cannabis companies are very risky. A lot of the times, retail investors or even my clients are better off playing it with an ETF like MJ. But Kronos is in a much better financial position than 90% of its competitors. It's a $2.5 billion company with $2 billion in cash on the books, and huge partners like Altria that will get them through any downturn in this cannabis market, whether that's pressure from industry pricing or the vaping scare. I think this is someone that's going to be nimble and even pick up some of the smaller players over time.
And lastly, a quick thought from you on Casper's IPO. I mean, it seems to have done well, but it had really cut its price before going public.
Yeah, they definitely marked down investors already. And look, it's a mattress company. In our eyes, there's nothing really special about it. There's 175 other direct-to-consumer mattress companies, and this is business 101. If you're selling something for $1,300 on average, and it costs you $1,700 to gain that customer and make that transaction, it's just not a good business model. This isn't a software as a service company. It's a transactional business, and definitely something that we're staying away from for now.
All right. Okay. Well, thanks a lot, Brett, for your thoughts.
Thanks, Fred.
Our thanks to Brett Sifling of Gerber Kawasaki joining us from California. I'm Fred Katayama, and this is Reuters.